Hello everybody, and thank you for joining us today. My name is Dan Valku and I am IFTA's Marketing Director, and it's a pleasure to welcome Dr. Bandi to a new IFTA webinar. It is especially hot in Europe and also other areas, and Dr. Bandi is going to drive temperature higher with his topics on trading systems development, I'm sure. The menu for today is very rich, spanning from goals, objective functions and metrics to indicator construction, risk assessment, walk-forward validation, and many other ideas in between. Your participation to this series proves that you are really interested in this hot topic that marries technical analysis with quantitative analysis, so feel free to contact Dr. Bandi for additional information. He is very kind and willing to offer his expertise. Dr. Bandi, you'll have the microphone in a second, but let me remind people that, as always, the Q&A session is at the end of the webinar, and if you have any questions during the webinar, please type them in the questions box. Dear colleagues, enjoy the marathon. So let me switch the screen to Dr. Bandi.
Thank you, Dan, and thanks to the IFTA for sponsoring this set of webinars. Today I'm speaking on trading system development from the perspective of indicator-based systems, and by that I mean trading systems that are developed using traditional trading system development platforms such as TradeStation or AmiBroker. There will be a machine learning equivalent of today's talk that will be offered in September, and there are possibly other webinars that will be offered in later months. What we're going to be talking about today is the scientific method and very evidence-based. This is a preview of the topics that we'll be covering. You can see it's quite extensive, and some of them are just brief mentions. Others you will hear in detail. Still others you will hear short pieces on several different times. There is a great deal of background in your invitation to attend this webinar. You may have seen that I recommended watching in particular 2 recording presentations. They're up on the screen today. You can do a Google search, Google Howard Bandi YouTube, or Howard Bandi, The Importance of Being Stationary, or The 4 Faces of Risk. These 2 are each a little over an hour long. The Importance of Being Stationary was presented to a Market Technicians Association meeting in Seattle, Washington, and The 4 Faces of Risk was presented as a webinar for the IFTA about a month ago. I believe that all traders have approximately the same goal. The goal is for the traders to have confidence that the signals generated by the trading system precede trades that provide rewards adequate to compensate for the risk. The key word is confidence, and the primary limitation is risk. Quantifiable confidence is developed by using these techniques: following the scientific method, performing out-of-sample testing, using lots of data, measuring results, computing statistics, using distributions, and by that I mean distributions rather than single metrics such as mean or standard deviation, and using Monte Carlo analysis. And as a side note, Monte Carlo analysis is one of the topics that's been requested, and I may be doing a webinar on that in October and November. The limitation is risk. I presented webinar titled The Four Faces of Risk, and that's the one that I mentioned on YouTube. There are several aspects to risk, and here are the four faces. Personal risk tolerance, risk inherent in a price series, risk of a trading system, and then risk management as conditions change. I will touch on these today, but for more detail, please watch the presentation that's recorded and is on YouTube. We begin by establishing a personal risk tolerance. We start with subjective evaluation, and from that move to an objective statement and the ability to plot on a chart. Here, for example, is a statement of risk tolerance. I'm trading a $100,000 account and forecasting 2 years into the future. I want to hold the risk of a drawdown greater than 20% to a chance of 5% or less. There are 4 parameters in that risk tolerance statement. The trading account initial balance, $100,000, plug in your own number there. The forecasting horizon, 2 years. Pick a reasonable number. 2 years is reasonable for most people. The longer out you try and forecast, the greater the uncertainty. The shorter you try and forecast, the more difficulty there is doing the modeling and simulation. The maximum drawdown limit of 20% is pretty aggressive. A lot of my money management friends and colleagues want to keep that to single digit. And the maximum chance of exceeding the maximum drawdown of 5%, that's a definition of what we would call the tail area. You can see where the 20% and 5% come from by the 2 boxes that are outlined. 20% on the left-hand axis, that's the drawdown we want to hold. 95% on the bottom, that's the cumulative probability or the percentile of 95%, and the 5% is the area to the right of that. Where those 2 dotted lines intersect is our risk tolerance. That is the circle area in the big red block that describes 5% risk of a 20% drawdown. The blue line that goes from the lower left curving up to the upper right represents the cumulative distribution function graphed for trades when the trades are each taken using 100% of funds available. The fact that that curve is above the circle at the intersection of 5%, 20% means that there is more risk in the trading system, and the interpretation is that the position size, the fraction of 1.0, is too large. And what we will need to do is reduce position size so that that curve is brought down and it intersects the 20%, 95% intersection. We can, and we should, evaluate the price history of the issue that we are considering trading. There is risk inherent in the price series even before we apply a trading system to it. It's difficult to see the prices on the graphs that are displayed, but in the upper left, the prices in this about 6-month period of time range between $10 and $20 with very serious open, high, low, close ranges. As we apply any system to that, we will find that no matter how accurate it is, that data series is too dangerous to trade. In the upper right, we see a very calm data series where there is very little variation. It's been graphed in such a way that it expands to fill the whole graph, and it appears there is variation there. But the open, high, low, close ranges are so small that even if we trade that perfectly, we don't make enough money to overcome the costs of trading. What we're looking for is something that is just right. And that's the big one in the middle bottom. We found a data series where it appears that we've got enough volatility to provide some profit, not so much volatility that we are scared away by any system. In other words, we're looking for Goldilocks price series. We're all familiar with the premises of technical analysis. The markets are not completely efficient. There is information, that is, patterns, in the historical price series that can be used to identify profitable trading opportunities. Trading systems can be designed to recognize the patterns and give buy and sell signals, and very importantly, patterns similar to those found in the historical data will continue to be found in future data. Our trading system development will follow the very well-known scientific method. It's usually described in this series of steps, and I've outlined 7 of them here. The next slides identify trading system development activity corresponding to each of these steps. First is a statement of the problem. We state the problem or ask a question in such a way that it can be tested through experimentation. The presentation is describing a very evidence-based methodology. We're asking the question, is it profitable to take a long position when the value of the RSI indicator is low or is high? The second step in the scientific process is observe the data and perform research. In the trading system development, we want to use a data series that we might want to trade, and we compute the value of the RSI indicator for that series. Step 3 is form a hypothesis. We formulate some rules, and in this case we're going to code the rules into the language of the trading system development platform. For example, the rules are enter a long position when the RSI value falls below some entry level where entry is yet to be defined, and exit to flat when the RSI value rises above some exit level yet to be defined. Translated into the language of a trading system development platform, it's an if statement. If RSI value crosses below entry level, then buy, followed by sometime later in time, if RSI value crosses above exit level, then sell. The next step is to perform experiments, and in trading system development, this is the backtest. This is the learning phase. We're asking, are there profitable patterns? We're going to be doing backtesting, optimization, and in general, learning. The outcomes must be quantifiable and they must be unambiguous. For a range of values, we're going to calculate the number of data points for the RSI, the look-back period, the entry level, an RSI value to enter, the exit level, an RSI value to exit, and we're going to let the trading system development platform generate buy and sell signals for us. This is in-sample learning. We're going to backtest and optimize, and the series of steps that indicates is pick the best values, simulate making the trades, create an equity curve, compute statistics, evaluate risk, and estimate profit potential. We want to identify the best result, and then we want to go on to the next step, which is validation. It's analyze the results of the experiments and do out-of-sample testing. We want to verify that learning has happened, not just memorization of the data, not just fitting the equations to the data but learning something that is general and that will work on data that has not yet been seen. So we're going to simulate making out-of-sample trades, create a new equity curve, the out-of-sample equity curve, compute statistics, evaluate risk, and estimate profit potential. And we will draw a conclusion. The in-sample, the backtest results always overestimate profit and underestimate risk. We get the best estimate of future performance by using out-of-sample results. So using the results of the validation runs, we draw a conclusion about the tradability of the system. Do the trades have the characteristics that you desire? Is the risk acceptable? Is the profit potential adequate? And is the system tradable? And as the last step of the scientific method, we use the results to make predictions. If the system is tradable, use it to analyze current data, generate signals, and take those trades. If the system is traded, it is predicting that profitable trades do follow patterns based on the RSI indicator identified in the data by the rules. What I'll present next is a schematic of trading systems. And this is an overview of both the development and trading. The development is the left-hand side, and that's all we're talking about today. The right-hand side is the trading part, and you will see that the two are coordinated and consolidated through a set of trades called the best estimate. The best estimate is the out-of-sample trades that come from the validation phase. So as you see on the left-hand side, we have an idea, we ask what to trade, how to trade, we have a set of data, we formulate some rules and logic that are incorporated into a model, we do some back testing, some searching, some learning, and we ask, is that promising? If it is, we go on to validation. If it's not, we modify the model, the rules and the logic, and we do additional testing. At some point, we say it looks like it has learned in sample, we test out of sample, ask whether or not the validation is passed, and if it has, then we can pass the system on to trading. The trading itself has a different model. What I want to focus on right now is the trading system model. And as is customary in modeling and simulation profession, all systems have a model, input data, and output results. Let me say that again. A system is a combination of a model and some data. The data is used as input, and the model produces output. The output of a trading system model is a trade list. You can see from the box in the middle, the model includes system parameters, alignments, transformations, indicators, pattern recognition, and so forth. It does some processing, produces entry and exit signals, resulting in a trade list. These are the components of trading systems. The model is rules, indicators, patterns, predictors, parameters. There is no position sizing in the model. As I describe in detail in some of my other presentations, if there is any position sizing in the model, it does two bad things. One is it forms a bias during learning that favors sequences of trades that are sequence dependent, and that is distorting. And the second thing it does is it removes from trading management the only possible management tool we have during trading. So it's important that trading systems have no position size. The model then should be working with a single contract for those of you who are trading futures, or with a fixed number of dollars per trade for those of you who are trading equities, and the results of the trades are the percentage gained or lost per trade. The input data is the primary data, the price series being traded, and conceivably auxiliary prices such as intermarket variables. The output is a trade list. I recommend that you develop your systems for single issues long and flat, and rather than work on portfolios, work first on a single issue. If you've got one that works for a single issue long and flat, you might consider that same issue short and flat, or you might go on to other systems, each of which is maintained separately. Underlying all trading systems is some mathematics. We're attempting to solve a complex set of simultaneous equations. The model is a set of rules, and we can think of each rule as a formula or an equation or a function. The data is the set of patterns or indicator values, one per bar. Importantly, this last point, the trading system development process is an attempt to find the best fit of the function to the data. Just for completion, this is what the trading management system looks like. You'll see that it is a system, it is a model with data, produces output. The model includes the risk tolerance, Monte Carlo analysis, dynamic position sizing, where position size is used to indicate the health of the system as it's being traded. The input is the shadow trades. Those are all the trades signaled by the system, whether they're actually taken or not. And the output is, at some point, realized trades. These are the components of the trading management system, the model, the input data, the output data. The link between development and management is the best estimate set of trades. Trading is managed through analysis of trades signaled by the trading system. The best estimate is the list of trades that you believe are the best estimate of the future. That should be as realistic as possible, as unbiased as possible, and the ideal is actual trades. The gold standard for systems under development is the set of out-of-sample trades from the walk-forward validation. There are two ways to think about signals and trades. Impulse versus state. We're all familiar with the impulse signals. They are buy, sell, short, and cover, and they mark the beginning and the ending of trades. They may be several days apart for trades lasting more than one day, and there are typically a few trades per evaluation period. State signals, be long, be flat, or be short, identify the signal to be held for the next period. I recommend mark-to-market daily, and there is a signal, a state signal, for every day. And here's the correspondence between the two. I've taken a short segment of price and applied a zigzag pattern to it, which identifies the lowest low and the highest high. And the very bottom line, where you see the impulse buy and sell, you'll notice a blip up to buy and a blip down to sell. Those are impulse signals that measure the beginning and the end of the trade. From the buy to the sell, we are in a long position, and the state signal says that day by day for that entire period of time, we should be long for the next day-to-day change. Management of a process requires measurement of the process. We should design our system so as there is no management other than that specified by the model. Specifically, there must be no subjective exits. Your trading system should include all entry and exit rules, You should always be willing to wait for your model to signal the exit to a position, and measuring daily gives an opportunity to manage daily. System development involves creating and evaluating many alternatives. We need a procedure to compare them and to choose the best among them. That is calculation and comparison of objective function value. It's sometimes called a fitness function. We are all experts at fooling ourselves. If you cannot precisely define your model, you are fooling yourself. And for a book-length analysis, I highly recommend reading the book Thinking Fast and Slow, written by Daniel Kahneman. From our perspective in trading system design, objective functions serve to quantify our subjective preferences. We're going to use objective functions to rank alternatives. And well-designed objective functions remove the need for trading psychologists. They remove the cognitive dissonance. Trades have characteristic, and some sets of trades are more desirable than others. Your objective function is your opportunity to list and rank the attributes of your system's trades. In general, we want to reward accuracy, trading frequency, and gain per trade, and penalize losing trades. You may have a different view of accuracy, trading frequency, and gain per trade than I do, but those are all components of objective functions that are good ones for including in the objective function. I recommend avoiding sequence-dependent metrics such as drawdown. Now, depending on your trading system development platform, you may have little or no control over that, but realize that if there's sequence-dependent metric, the trading system alternative that is preferred will be the one that minimizes the sequence-dependent part, the drawdown part, but you cannot depend on order dependence in the future. So having sequence-dependent metrics will introduce a bias that you probably want to avoid. I recommend that you rank some test functions, some test results, both subjectively and using your objective function. The order of that preference should agree. And we'll go on now to a discussion of indicators. We are in the pattern recognition business. We are searching for patterns. We are searching for patterns that precede profitable trades. And they could be anything. They could be a sequence of bar relations such as 3 black crows, 3 candlesticks that go down, down, down. Chart patterns such as trendline break. Dates such as the traditional harvest for an agricultural commodity. Indicators and rules based on indicators such as the RSI values. We'll see those in a moment. Or anything else that you can imagine. Best patterns have these characteristics. They are unambiguous in definition. There is no repainting, where by repainting I mean that after additional data is received, the value of the previously computed and plotted indicator changes. There is no revision, and by revision I mean the kind of thing that happens with government reports, where there's a preliminary result and then later a revised result. And it's important that the patterns occur at about the same frequency as the trades that you're hoping your system will be recognizing. Now, there are 2 ways of thinking about the pattern-trade relationship. One is to think about the indicator first. The other is to think about the trade first. If we think about the indicator first, we compute an indicator and see what happens later. And that's what we're doing with traditional technical analysis development platforms. With the trade first, we identify desirable trades, and see what happened earlier. To some extent, we can do that with a traditional platform, but that's a characteristic of machine learning. In machine learning, we will look for a desirable target, the trade we want to take, and then look for the patterns that precede that target. Some condition must change to generate a signal. If the indicators are used to define trades, it looks like an if-then-else statement. If some condition, if the result of that condition test is true, do signal 1. If it's false, do the else, signal 2. Signals require changes in indicators. If there is no change, there is no signal. And as a trivial example, if the Earth's mean temperature is greater than 0, then buy, else sell. The Earth's mean temperature is going to be greater than 0 for our entire lifetime, so there would never be a sell signal. It would be buy and hold. My point is, as we're looking at indicators, we need to be looking for changes in the indicator at about the same frequency as we want signals for our trades. Indicator-based models are decision tree models. Next month, as we discuss machine learning, we will discuss other models. The if-then-else defines a decision tree. It divides the pattern space into areas based on the value of the indicator. Ideally, there's a strong relationship between the indicator and the pattern. And wouldn't you love to have an indicator like this one? What we're trying to do is divide the gain per day ahead, which is plotted on the vertical axis, into gaining days and losing days. In other words, we want to draw a horizontal line that separates winners from losers. The indicator we have goes from 0 on the left to 100 on the right. We want to accomplish the separation vertically by drawing a line on the horizontal axis. In other words, we want to draw a vertical line resulting in a horizontal division. The data is seldom that clear. When the relationship is less strong, we must make some compromises. And you can see from the vertical line at 50, below the slanting line, if we limit RSI to 50 or below, it does not eliminate all of the losing trades. If we move the vertical line to the left so that we set the RSI limit to eliminate all of the points where the gain ahead is a loser, we also remove some of the profitable trades. The only way, in general, to eliminate all of the losing trades is to move the vertical line all the way to the left and not trade at all, because this is what the data really looks like. So we can see it's no wonder we're having difficulty separating the signal from the noise. This is the actual RSI versus gain ahead. Now, there are lots of indicators. Some of them are potentially useful. And here's a list of things that you might conceivably use. RSI, which is the badly named relative strength index. Any of the position and range indicators, such as percent rank, stochastic, percent R. Commodity channel index, detrended price oscillator, moving average, convergence, divergence. Any of the volatility measures, average true range, percent B, standard deviation, price rate of change, regression fit, new high breakout, etc. Other indicators are not so useful. Watch out for indicators such as the zigzag that has a future leak. We can't identify a bottom until some number of bars after the bottom, and the bottom has been confirmed. Watch out for Fibonacci, which repaints. As additional data comes in, it computes a new place for the 50% retracement. Watch out for Elliott. It repaints. As new data comes in, it recomputes the counts. Watch out for Gann, which is imprecise, as is divergence. And if any of the audience has precise indications of Gann or divergence, I would like to know about those and I would help you test them. Beware of chart patterns, head and shoulders, support, resistance, wedge, flag, and so forth. They tend to be both imprecise and subject to repainting. Watch out for indicators that have very long lags, ADX for example. Anything that looks back more than 5 or 10 days, 5 or 10 bars, is unlikely to be a good indicator. Beware of government reports, redefinition, backtest only overfitting, the granularity. By that I mean that the government report is issued quarterly or monthly. We're trading daily. There's no change in between reports, so we don't get a signal change. The data is regularly revised some number of days or weeks or quarters later. And there's certainly a bias. The same flaws for fundamental corporate data, granularity, revision, bias, and corporate reorganization such as mergers or spin-off of divisions. There are no favorable biases, so we want to avoid these biases. Survivorship, which means, for example, testing only the current components of the S&P 500. Those companies that used to be in the S&P 500 that financially failed and were removed are no longer in the membership. So by testing the current members, we're testing companies that have survived. Membership bias, such as those companies that are constituents of something like a sector fund, the S&P sectors, XLB, XLE, XLF, the select sectors, change membership periodically. Be aware that if you're testing long only, you don't want to do it to a data series that is upward rising without compensating for that. Be careful about stationarity. We'll visit that in the future. Be careful about assumptions about distribution. The distribution of the data is completely immaterial. One, we can't tell what it is. Two, even if we did know, it wouldn't do us any good. And a very serious one, which we will see in a minute, is avoid the bias of classical ancestry. And by that I mean avoid the bias of something that seems to be traditional wisdom in the technical analysis community, that it's always been done and it is termed to be good, but it is seldom tested. On the other hand, we want to be very evidence-based. We want to assume nothing and we want to use the scientific method. So we will perform experiments ourselves and examine the evidence. Now this is not an exact science. There are many reasons profitable systems are hard to develop. There are no strong predictive relationships. There is a lot of ambiguity. We're searching for a weak signal in a noisy background. And if we measure trade by trade or signal by signal, the gain per trade, the standard deviation is much greater than the mean, which means we can't use industrial control techniques to help us. One of the things that's commonly considered in trading system development is multiple indicators. And we ask how many indicators are enough. If, for example, RSI works well, what if we add other indicators such as %P, CCI, a trend filter, and so forth? First, the additional indicators should be independent, and second, they should be predictive. One of the things we find by doing a statistical analysis called principal component analysis, it shows that for the systems that are going to pass validation, all of these indicators are so similar that only one of them is required. The others will be redundant. Remember, we're solving simultaneous equations. We have two numbers to keep in mind. N, which is the number of data points in a given period, 252 if we're using daily mark-to-market in each year, and many fewer, from 0 to 30 or so, if we're using impulse signals. And P is the number of combinations of parameter values used to fit the rules to the data. When P is greater than N, that essentially guarantees that we will have an overfit model. Run back to an earlier slide asking how many indicators we should have. Every time we add an indicator, we increase P. Think about N as the number of rows in a spreadsheet and P in the number of columns. And we're trying to do a fit of simultaneous equations. Time series, particularly financial time series, complicate system development. Essentially all the modeling and simulation literature assumes the data is stationary. Please watch my presentation on stationarity. Process or a set of data is said to be stationary when the distribution and its parameters do not change over time. Stationary is a required condition for most analysis techniques. In complicating our task, financial time series data is never stationary over long periods. If we apply techniques that assume the data is stationary when it is not, it will result in an undesirable bias. In particular, there will not be learning. There is a big elephant in the room, and that is that the stationarity is typically ignored. And whenever you read an article, look for the author's recognition of and treatment of non-stationarity. If it's missing, be aware that the results have an unfavorable bias. Nothing is stationary. Price is not stationary. Trades are not stationary. Stationarity is related to a period of observation, and we need to ask and then determine, is there a time span over which trades are stationary? If so, how do we determine it? And what do we do when we know it? There's no way to tell without experiments. It must be long enough to learn the patterns, plus long enough to trade the signals identified by the patterns. As you look at the top of the two boxes, the one that says in-sample is backtesting and optimization. That's where we're learning. The one that says out-of-sample is validation. That's where we're testing to see whether we have really learned. Note the relationship of in-sample and out-of-sample. If the system is not stationary, what has been learned in-sample will no longer be true out-of-sample. The minimum length of stationarity is some period of time to learn or train and some period of time to test or trade. So on to the discussion of entries and exits. The discussion of entries is intentionally short. If you work through the analysis, the only systems that pass validation trade frequently, hold a short period of time. Any fast-acting oscillator can be used to signal entry. Infrequent patterns or slow-acting indicators result in systems that are not safe to trade. However the entry was signaled, the model must have rules to signal exit. there must be no subjective or external exits. There are 5 broad exit techniques. I'll go over each of these in a moment. Logic, holding period, profit target, trailing exit, and maximum loss exit. The model must have at least one and may have all 5. The first condition met will cause the exit, and each exit technique should cause enough trades to provide statistics for that technique alone. The logic exit is an exit using rules or patterns. It's generally the best exit. There's no requirement that the same rule, pattern, or indicator used to exit as were used to enter. And even if they are the same, there's no requirement that the parameter values be symmetric. The holding period exit exits after some number of bars, and that can be determined prior to or at entry or during the trade. Inactivity might be one of the factors. Holding period exits work well for trades that are held a short period of time and when the system has a reliable cyclic period. The holding period exit is often entered as a market order, such as market on close. Profit target exits exit after some predetermined profit has been achieved, and that can be determined prior to or at entry or during the trade. Profit target exits often work well for trades that are held a short period of time. They're entered as limit orders, and there is little or no slippage. Trailing exit. The process is to compute and regularly update a price level that, for a long position, begins below the entry price and moves upward as the trade progresses and or as time passes. It's implemented as a stop order, and every time the price changes, the order must be periodically adjusted using a cancel and replace. Trailing exits require some number of bars to catch up, and if you're using daily bars, the trailing exit requires either a holding period of several days or alternatively intraday bars and the corresponding requirement for intraday order adjustment, cancel and replace. Typically, the trailing price moves in only one direction, toward the current price, and the exit is executed when either the trailing price rises to the current price or the current price falls to the trailing price. There are 2 widely used and well-documented trailing exit techniques, chandelier and parabolic. I discuss both of those in a couple of places in my books. These will be executed as stop orders, and there will be slippage. The maximum loss exit is the notorious money stop, where you compute a price level that represents the maximum loss that's allowed. Place a stop order at that price below, that is for a long position, and the maximum loss exit is implemented as a stop order. There definitely will be slippage. Generally, maximum loss exits hurt system performance, but that's not to say they should not be used. In general, over a reasonable period of time, say a year, every exit coded into the system should be responsible for terminating multiple trades, enough so that you get statistics from it, and avoid setting exit conditions for special cases that are unlikely to be repeated in the future. If you set an exit to behave well during the crash of October 87 or the flash crash of a couple of years ago, you can be certain that trading systems that are developed will treat those particular events profitably or at least benignly, but there's no assurance that those conditions are going to happen again in the future. So we'll do an example. This is the procedure I recommend for evaluating a trading system. We'll outline the model, identify data, using a net flat period to avoid a long-only bias, fit the model to the data, show the statistical summary, show a single backtest equity curve, show a chart of trades forecast 2 years ahead, compute the risk at full fraction, compute the risk at safe F, compute the profit at safe F, and identify the profit potential in credible interval. This model is going to be long flat. It assumes the data is stationary throughout the period tested. It selects a look-back period for the RSI indicator, compares the value of the RSI with entry and exit levels, issuing buy and sell signals when the indicator crosses the level. We're using SPY for the 13 years 1999 through 2011, and that's a net flat period. Here is the AmiBroker code. We need to write the model in the language of some development platform. I like AmiBroker, but TradeStation or Ninja would be just as appropriate. Note that we're testing the classical ancestry here, buying high RSI, as well as the evidence-based system by low RSI. We're going to create and evaluate many alternatives. Over a period of time for which the data is reasonably stationary, search for the rules and values of the parameters that give the highest objective function score. In this model, there are 3 variables: the look-back length of the RSI, the level for the buy, and the level for the sell. These are the results following the advice given 40 years ago, repeated regularly and seldom tested. It buys when the RSI closes through, rising through some level, and sells when it drops below some other level. The look-back period is 33 days. We buy a rise through 58 and sell a subsequent drop through 38. There are only 3 trades in this 13-year period, and this system is completely untradeable. In fact, with only 3 trades, it's completely unanalyzable. If we look at buying a low RSI, the best look-back length is 2 bars, 2 days. We buy when the 2-day RSI drops through 33 and sell when it rises through 34. These are the evidence-based results, and they are obtained by removing restrictions to rules and following the objective function. There are 500 trades, each one of which is 0.27%, held a little over 2 days, 71% accurate, and that's a reasonable looking equity curve. The process of developing the system is a process of repeated learn and test, in sample, out of sample, at each test moving forward by the amount of an out of sample period in a walk forward process. Eventually, after we've gone through several walk forward steps, we concatenate together all of the out of sample results and we decide whether to trade the system or return it to development. And when you think about it, you do want to use walk forward. Walk forward is the gold standard. Each time the system is adjusted or resynchronized and then put back into live operation, you are performing a walk forward step. So walk forward processing gives an opportunity to practice what will happen as you go from development to trading, and you can practice it at no financial risk. For that system, here are the trades in original order, and here they are in sorted order. The large losers at the left are the limiting trades. If we compute the 2-year forecast taking every signal with all funds, we see that the blue line is above the red circle, which means that the risk exceeds our tolerance. In other words, even as sweet as that equity curve looked, we cannot afford to take all the trades with all of our money. It will be too risky. So through a trial and error procedure, we find out what fraction we can use. It turns out it's 89%, and that drops the cumulative distribution function of drawdown down so that it meets our risk tolerance. Given the 89%, here's the profit potential. We can see that the 25% percentile, the $100,000 becomes $109,000 and the compound annual rate of return is 4.6%. And at 75% level, the CAR is 15%. So equally likely the profit will be less than 4.6% or greater than 15.3%, and probably in the range of 4 to 15. Note the red line at the left. There's a 12% chance that there will be a loss over a 2-year period if future conditions are the same as past conditions, but the sequence may be different. This is risk-normalized profit potential. So is this profit adequate? Well, we compare with the other uses of funds and decide whether to trade the system. And to summarize, you must be able to rank alternatives, discard assumptions, test everything. You must find a profitable pattern with acceptable risk, and you must verify that the pattern and profitability persist out of sample. Follow the scientific method, define your risk tolerance, define your objective function, pick one indicator, pick a stationary period for learning, reserve some more recent data for validation, find the best model in sample, and evaluate out of sample. This is my latest book. It was published in January 2015, and it explains the topics that I covered in this presentation in much more detail, including fully disclosed computer codes. That is the 5th of my books. Here are all of them. Each book has its own website. And here is my contact information. At this point, I'm at the end of the presentation, and I'll turn it back to Dan. Thank you.
Thank you very much. It has been very, very interesting, as always, in fact, and the beauty with this presentation was the fact that you outlined the main steps traders face when they build a trading system, and you also explained as much as the time allowed us these steps. So I do hope that everybody liked this approach, and I think this approach saves everybody lots of time in building a trading system. Thank you very much again, Howard. Okay, now let's go to some questions. We have questions here, and one comes from Carlo, and he's asking the following questions. Is there any method to select ex ante the series instruments adequate for a trading system?
You could. On the other hand, my experience is that only perhaps 10% of all available series will have the characteristics that they result in tradable systems even before the patterns are found. So if you're trying to do it ex ante, where essentially you test all series and then look back to see which ones work, you have two problems. One is you've wasted a lot of effort, and the other is you've essentially optimized the symbol space, which means you've done the shotgun approach where you try lots of things and select just a few that worked. I recommend just doing some research into the data series first, and then focusing the development effort on those data series that have a chance of passing validation.
Good. Another question is from Carl. What does CAR means?
CAR is compounded annual rate of return, and there are two metrics that I believe are unique to me. One is SafeF, which is the position size at which trades taken have a risk that is acceptable and is in agreement with the personal risk tolerance. And at that position size, or actually at any position size, you can compute what the compound annual rate of return will be, but rather than focus on a single metric such as the mean, the compound annual rate of return at the 25th percentile gives an indication that if you do this four times, 3 times the result will be greater than CAR 25, and once it will be less than CAR 25. It's an indication based on the distribution and a conservative estimate of rate of return, rather than looking at a single metric and assuming that you're going to achieve the metric working forward.
Good, thank you. Another one from Michael. Were those 500 trades impulse or state?
They're the same. The indicator, the signals, the state signals and the impulse signals are equivalent, and I go through a derivation of why they're equivalent and show using many examples in the blue book that is titled Quantitative Technical Analysis. I recommend using impulse signals because you get mark-to-market daily, which is, daily is important. That's the same frequency that you and your closest friend or your spouse and your accounting margin clerk all look at your account. And it also gives an opportunity then to manage daily. So if there's a series of bad trades, you don't have to wait for the trade to end if you're doing mark-to-market daily and your model is built in such a way that it recognizes early exit. You also get an opportunity to apply the second model, the model that comes with trading management, and recognize poor performance and change position size as a management technique. So I strongly recommend mark-to-market daily and state signals.
Good. Another question coming from Rolf regarding the VAR. Isn't the position size algorithm quite similar to VAR? It has defining a risk value that you will not exceed with a probability of 95%?
Yes, the dynamic position sizing does it trade by trade. It uses a technique that's based on Bayesian statistics. It's typically called something like experimental Bayes or something like that, where as each additional data point is received, the risk is recalculated and the safe position size recalculated and the corresponding profit potential recalculated. And that feeds into a management decision model that asks, is the system healthy? Is the estimated profit sufficient to take on the estimated risk?
Okay, good. And all this information is described in your books, correct?
Yes, it is, including downloadable code.
Okay. So this is a nice opportunity for everybody who really wants to go this path to buy your books and to get your expertise through the books. Okay, do we have any other question? Let me see. No, we don't. Okay, so what else can I say? Let me go back to my slide. I have a slide here. that I have to show. Okay, so this event has been sponsored by CI Capital from Cairo, Egypt. Thank you very much. I hope you enjoyed the presentation. It has comprehensive as always. So we are looking at the next. We are looking forward to seeing you, hearing you again in September and October. All right. So I know that topics are very interesting and they are related to these two, to the previous two. Now tomorrow everybody will get a survey, and please, it would be nice to take 1 minute or 2 minutes to answer this survey, because it's very important for us to see which direction we go into, if this is the right thing we do, and so on and so forth. IFTA believes a lot into consulting with its colleagues and societies. So what else can I say? Nothing. Thank you very much for today, everybody. This webinar will be recorded, so the societies will get a recording, and it will be distributed to each of you who attended it. Okay, from my part, Dan Valku, thank you very much, and enjoy the rest of the day and the rest of the week. Be safe. Thank you. Bye-bye.
Thank you. Goodbye.
Thank you.